Hello, fellow investors. I'm Ben, and this is GVD Investing, where I break down the latest stock market news, analyze stocks, and share my personal investment journey in hopes of making us all better investors.
In this video, the second half of a two-part series that will give you a bit of insight into my life as an entrepreneur and investor, we'll take a deep look into my portfolio after my first year as an investor. I'll go through the process of building my portfolio, my investing strategy, all of my current holdings, my top performers, my biggest positions, and my biggest mistakes of 2020. I hope these videos will give you guys a better idea of who I am and why I decided to start this channel. There's a lot to cover in this video, and I don't want to waste your time. So let's get to it. There are a couple of things that came together that led me to investing. The first, as I discussed in detail in my previous video, was my experience running a business for the last 8 years, interest in pursuing other business ventures as I get older, and the need to grow my personal wealth. And second, I've always been a huge sports fan. In recent years, I've spent many hours in fantasy leagues for hockey, basketball, and baseball. Given my love of sports and stats, fantasy sports came naturally. I do extremely well most of the time and typically finish in the top 3 regardless of the sport. The only bummer was that most of the leagues were free, so even if I won, it was purely for bragging rights. This was fun and all, but fantasy sports consumes a ton of time, and at the end of each season, you have to start from scratch and do it all again. I wondered if there was a way I could use my skills from fantasy sports to actually make money without gambling. Sports betting as a career is a pretty risky lifestyle, so I had to find something similar, but far less risky. So, I started doing some research online, and this led me to YouTube to watch videos about making passive income. I'd never heard of passive income before. It's possible to make money without working for it? I watched hours and hours of ways to make passive income. All the common themes: affiliate marketing, drop shipping, selling courses, starting a YouTube channel, offering services on Upwork or Fiverr, income properties, and dividend investing. This immediately sparked my interest. I had no idea what a dividend was. I honestly really had no idea how the stock market worked. I didn't realize that owning shares actually meant you own a small percentage of a business, and that they would pay you a small percentage back as a reward for holding their stock. I learned about the power of compounding interest, and my mind was officially blown. I started researching more, spent endless hours listening to Warren Buffett talk, while starting to follow a bunch of stock market YouTubers. Warren hammered home the idea that you don't need to be a genius to be a good investor, while the YouTubers showed me that it's possible for an everyday person to have success in the stock market. I had spent so many winters researching different business ideas that I could potentially get going in addition to my landscape company, but the one thing that always held me back was time and capital. After learning about the stock market, I couldn't believe what I was hearing. I can put small amounts of money, or whatever I can afford, into businesses that I like, and the better they do as a company, the more money I make? This honestly sounded too good to be true. Seemed like a way better idea than trying to get another business off the ground myself. If I could combine my stat skills learned from playing fantasy sports with my business knowledge and newfound ability to actually save money, then I figured I would have a pretty good shot at doing well as an investor. The only problem was, I had no idea how to get started, and no one in my immediate circle of friends or family had any experience investing or managing a stock portfolio. So I set up a meeting with a financial advisor at TD Bank and continued watching as many YouTube videos as I possibly could in the meantime. It's amazing the amount of information you can find online for free. So many skilled investors willing to share their knowledge and experiences. I soaked up as much information as I could, and after my meeting at TD, I was all set up and ready to start investing. Opening an account at TD would turn out to be my first and largest investing mistake of 2020. More on that in a sec. Looking back, January 2020 was a very interesting time to get started investing. At that point, the stock market was at the peak of a decade-long bull run, and though many investors were warning of an upcoming crash, no one had any idea what was in store for 2020. There certainly was no talk of a global pandemic shutting down economies around the world. Anyways, I sent $250 over to my TD account, and it was time to buy my first shares. After watching so many Buffett videos and having such a small amount of money to get started with, I figured it was time to go shopping for value stocks. I picked up 50 shares of Aurora, 10 shares of General Electric, and 2,000 shares of a local licensed cannabis producer called Believe. that was actually one of my landscape customers. I knew them personally and figured with a share price of only 3 cents, why not pick up some shares and see how they do? This would be another learning experience of 2020, as they would file for bankruptcy by the end of the summer. Prior to opening my account at TD, I had done a bunch of research on different brokerage apps, but for some reason, Wealthsimple Trade never came up. Just the Canadian banks and Questrade. I think it was because Wealthsimple was still really new and hadn't gained nearly as much traction last January as it has now. However, not long after opening my account at TD, I started getting bombarded with ads for commission-free trades on Wealthsimple. After confirming this was the case, it was a no-brainer to move my investments from TD to Wealthsimple and use that app instead. Pay $10 per trade using TD or absolutely nothing using Wealthsimple. You do the math. So, I sent my whole but very small portfolio from TD to Wealthsimple. It was worth $250 when I sent it, but by the time it was deposited in my Wealthsimple account, TD had taken more than 50% of it in fees for transferring to a different brokerage. I had less than $100 by the time the transfer went through. Needless to say, I was extremely pissed. Apparently, it's somewhere in the extremely fine print on one of the many pieces of paper they made me sign prior to opening my account. Furthermore, TD told me not to worry about it. Wealthsimple would pay the transfer fee. No, they wouldn't. Wealthsimple will reimburse fees if the account you're moving is over $10,000, but not if the account is that small. I tried to no avail. That money was gone and would actually prove to be my biggest loss of 2020. Lesson learned. Screw the big banks. Now, through January and February, with everything finally moved over to Wealthsimple, I just kept adding small amounts every week, around $100 or so. I was focused strictly on dividend-paying companies and a few penny stocks. By early March, I had around $1,000 invested when the market absolutely tanked. My account fell 30% over the course of a few days, but fortunately, I didn't panic and had kept some cash on the sidelines ready to deploy if the market fell. I was ready to buy given everything I had learned about buying when the market dips. Having no idea when the bottom would come, I just kept dollar cost averaging every week. I even sold a piece of landscape equipment I no longer needed to have some extra cash to invest. It was easy to find companies on sale. Everything was going down. The hard part was choosing where to put the money, as most stocks looked like huge deals. Being new to investing, I was totally overwhelmed. I just started loading up on all the best known Canadian dividend stocks. I was hooked on the idea of dividends and everything was on sale. After using most of the money I put in on dividend stocks, I would use any small amount of money left in my account to purchase riskier penny stocks. I wanted to diversify. As we know now, the crash was extremely short-lived. Most companies started to rebound by the end of March. This didn't leave much time to establish sizable positions in most of the companies I had started investing into, as I wasn't working with a lot of money, and I was overly focused on diversifying rather than putting bigger amounts of money into companies I was more bullish on. It took until early May before my portfolio finally went into the green. For the first 5 months of the year, I was in the red the whole time. It was such a good feeling when it finally broke into the green. Over the course of the next few months, I just kept dollar cost averaging as the market continued to rebound, adding to my existing positions while still continuing to diversify. In just a few months, I now had a portfolio of more than 30 companies. Honestly, I probably would have been better off just buying an ETF, especially one of ARK Invest's, but I still hadn't learned my lesson quite yet. In my ignorance, I had neglected to consider investing in growth stocks that don't pay dividends. This would be another lesson for 2020. My account slowly crept up over the first half of the summer, but I started to realize that certain investors were pulling in massive gains while my account was barely moving. Primarily Jeremy from Financial Education and Kathy Wood from ARK Invest. Both of them focused most of their investments on disruptive growth companies, not just established blue-chip dividend-paying companies. Now, of course, it would be impossible to argue with Buffett's track record and method of investing, but it seemed like there was another way to investing that is extremely successful right now, not overly risky, and provided far better returns. You can't argue with Jeremy having back-to-back years of 90% plus, or the returns of any of the ARK Invest ETFs. You can't argue with their numbers. Stats are stats. Historically, Warren Buffett is one of the GOATs, if not the GOAT. But much like when Steph Curry entered the NBA and changed the game forever, It seems like Jeremy and Kathy have a different way to play the game that is working right now. Not only are the returns outstanding, the idea of investing in exciting, growing companies is far more enticing to me than trying to find old, beaten down dividend payers in hopes of them making a rebound. Buffett's investment into the airlines in March was a perfect example that sometimes old, proven methods don't always work. He bought Delta Airlines after it had tanked because it seemed like a great deal. It then proceeded to tank even farther to the point even the Oracle of Omaha couldn't take it. So he completely sold his position in all the airlines, only to have the airlines rebound above his cost basis within a few weeks. While Buffett and Berkshire Hathaway were losing hundreds of millions trying to catch a falling knife, countless investors were seeing unthinkable returns investing in companies like Tesla, Zoom, Shopify, Square, and Beyond Meat, just to name a few. Returns that would take dividend stocks years or decades to provide the same gains. I decided it was time to change things up a bit. I wasn't going to completely abandon dividend stock investing. I would keep my favorite ones, but I wanted to switch my focus to investing in growth, innovation, and disruption. Obviously, there can be more risk involved, but after seeing how many blue chip companies got completely destroyed in March, while many of the riskier growth stocks didn't fall as much, rebounded way quicker, and provided way larger returns during a once-in-a-100-year event, I figured the potential upside was worth the risk. Is it really safer just because it's an old, established dividend-paying company? Given what I saw last spring, I would argue no. As a noob investor, I found the allure of dividends and passive income hard to resist. I think this can be a trap that lures in many new investors. I wasn't necessarily searching for high dividend yields, but I wouldn't even consider investing in any established company unless it paid a dividend. I missed many great investment opportunities in the spring and summer of 2020 because I was too focused on collecting dividends. Don't get me wrong, passive income is an amazing thing and the ultimate goal of my portfolio. However, unless you're working with large sums of money, the amount you collect in dividends is relatively insignificant. The $3 I was getting every month from various REITs wasn't changing my life very much. Obviously, over a long period of time, the dividends will compound and offer increased passive income, but here in Canada, we have limited contribution room in our TFSAs, so the cash from dividends on a fully maxed out but slow growing dividend portfolio of roughly $75,000 won't provide much passive income. Even at a 5% yield on the entire portfolio, you'd only make $3,750 a year or $312.50 a month. And good luck getting a 5% yield on your entire portfolio. Given my age and risk tolerance, I wanted to try another approach. Knowing my goal is to eventually grow my account to the point where I can live on the tax-free passive income it generates, and that there is limited contribution room in a TFSA that can be increased by growing the account above the contribution limit, then materializing those gains, my new goal was to grow the contribution limit as much as possible over the next 10 to 15 years by investing in rapidly growing disruptive companies. Then, once the account has grown to a point where the dividend income would be enough to support my life, at that point, I'll consider moving the money from riskier growth stocks into more stable, dividend-paying companies to provide passive income. Currently, in 2021, the total contribution limit for a TFSA is $75,000, with another $6,000 added annually. I'm going to attempt to grow that contribution limit strategically to between $750,000 and $1 million before switching from mostly growth stocks to dividend payers. This won't be easy, carries way more risk, and may be a bit ambitious, but I think it is possible. Personally, I don't feel that just because a company is a growth company, that it's a risky investment. You can still use Warren Buffett or Peter Lynch's investing concepts, they just need to be applied a bit differently. It was time for a portfolio overhaul. Fortunately, by this point in the summer, I was up on most of my holdings, even if it wasn't much. I had invested $11,000 and was up around $1,000. I decided I was only going to keep a few of my favorite dividend payers, and the rest would be sold and reinvested into faster growing companies. Over the next few weeks, I sold out my positions in Canadian Tire, Fortis, Sun Life Financial, BMO Equal Banks ETF, TELUS, VFC, Chartwell REIT, Killam Apartment REIT, Northwest Healthcare REIT, and a few other really small positions that I had added during my rush to diversify early on. This was a risky decision and one I wasn't sure if I would regret or not. Selling all of these companies meant losing the cost basis I'd established when the market crashed in March to buy more expensive and, what many considered overvalued growth stocks at prices that had already recovered significantly since the March lows. Tesla stock had just split, and I wanted in now that I could finally afford to buy more than 1 or 2 shares. Given the timing, this was definitely my riskiest investment of 2020. Everyone on YouTube and Wall Street was screaming to stay away from Tesla stock. Even most of the Tesla bulls were saying it was overvalued. I didn't care and knew that even though the evaluation was extremely high, Tesla would eventually grow to justify it. I just had no idea it would be this fast. I used the cash I had from selling the blue chip companies and other small positions to dollar cost average into Tesla, Square, DraftKings, Chewy, Switch, Workhorse, and Nikola. My investment into Nikola would be extremely short-lived. As I explained in greater detail in one of my other videos, I got into Nikola just before the short report, but fortunately made the quick decision to sell right away and wound up losing only $100. Other than that minor mistake, overhauling my portfolio turned out to be the best decision I made last year and the best decision I've ever made financially. The returns since speak for themselves. Since then, my account is up over 50%. However, I had one mistake left that I needed to erase from my portfolio. Aurora. Fortunately, being one of my first investments, I had only invested less than $500 into Aurora, but my position was down over 60%. I really didn't want to materialize those losses, but I wanted out. So, I came up with a plan. A risky one. My cost basis was terrible due to Aurora's reverse split that left me with an average cost of $18 per share, when ACB was now selling for around $6 a share at the time. I didn't want to lose any more money, but needed to bring my cost basis down, so decided I would use dividend cash, free money, to slowly reduce the average. Looking at ACB's stock chart, I saw that occasionally, and out of nowhere, the stock would make huge rebounds before crashing again. One thing I learned in my first year investing is that sometimes stock performance doesn't always make sense. I was hoping there would be another irrational jump in the stock. I was banking on it. Using dividends, I was able to get the cost basis down to just over $13. Then election day in the US came along with news that Biden had won and would decriminalize marijuana, which caused all cannabis stocks to skyrocket. Aurora popped well over 100% in a couple days, which erased all of my losses. I completely sold out of my position and was actually able to make a tiny profit. My patience had actually paid off. Since August, I had done a bit more reshuffling and added a few more positions to my portfolio, but have tried to keep it to less than 20 holdings. I actually sold my position in Workhorse and Switch and moved those funds into Beyond Meat, Good Food, Neo, and Alibaba, while continuing to add money to my account weekly to grow my existing positions. My method is pretty simple. I put money in, see what company in my portfolio is on sale, and buy shares of that company. Whatever company is on sale when I put money in is where I deploy the most cash. Then, as it starts to rebound, I find another stock in my portfolio that is pulling back and start adding to that position instead. This strategy has worked extremely well for me over the last 6 months. I'm finally at a point now that I'm really happy with the structure and diversity of my portfolio. If you look at my stock chart, it shows the power of dollar cost averaging over the course of a year and how that can weather market corrections. There was a massive crash in March and then 2 smaller corrections, one in September and one in October, and none of those even show up on my stock chart anymore as I use those dips as buying opportunities to load up on shares at discounted prices. Even though my portfolio is theoretically prone to more volatility, I wouldn't say it's necessarily riskier. The penny stocks obviously carry more risk as they aren't proven yet, but I keep those as smaller positions in my portfolio and spread that risk between 5 to 10 different spec companies. That said, of the 7 penny stocks I'm invested in, I'm up over 100% on 5 of the 7, 95% on one, and down 25% on the other. Not bad if you ask me. I don't plan on selling any of those anytime soon. The performance of my portfolio since making those changes in August has been extremely rewarding for me to watch. By New Year's, my account was up over 30%. I had invested $19,000 and grown that into $25,000. Things haven't slowed down since New Year's either. Since then, I've invested another $1,000 to make it an even $20,000, but the account is now up over 50% or $11,000 in total. If you would have told me at this time last year that I would be able to save $20,000 and grow that into over 30,000 in less than 12 months, I would have laughed at you. Now, let's take a look at my portfolio and go over all of my current positions, the top performers, biggest positions, and biggest losers. So, here's my portfolio after my first 12 months. For me, it's truly hard to believe that I'm up 61% or just over 12K in my first year. Since switching up my portfolio in late August, my account has absolutely taken off. In just the first month of 2021, the account went up $6,000 or 23%. I now have 20 holdings in my portfolio, 2 dividend stocks, 11 growth stocks, and 7 penny stocks or spec plays. Of the 13 main companies, 4 are Canadian, 2 are Chinese, and 7 are American. All of the penny stocks are Canadian, as Wealthsimple typically doesn't offer foreign companies traded over the counter. The 2 dividend stocks I have in my portfolio are Algonquin Power and Northland Power. I really like both of these companies given their exposure to renewables, steady capital appreciation, and solid dividends. I could see myself holding both of these companies for the rest of my life. Then I have 2 Canadian growth companies, Good Food and Afria. Both of these have performed really well for me, and I plan to grow Good Food into one of the larger positions in my portfolio in 2021. I wanted some exposure to the rapidly growing Chinese economy, so I've invested in NIO and Alibaba. I expect NIO to become China's largest EV company, while Alibaba already has complete control of e-commerce in the world's most populated country. As more people join the middle class in China, I fully expect Alibaba to continue their rapid growth. Obviously, there is some risk investing in Chinese companies, so I will keep both positions to smaller allocations in my portfolio, but for the most part, I think the risk is largely media speculation and political bickering. Then I have my American holdings: Tesla, Square, DraftKings, Beyond Meat, Chewy, Opendoor, and MP Materials. I just recently opened positions in Opendoor and MP Materials, 2 Chamath SPACs, but the other 5 companies make up the majority of my portfolio. In fact, these companies are 5 of my 6 biggest positions. Tesla is my largest position and my biggest gainer in terms of capital gains. I do have penny stocks that are up more in terms of percentages, but I didn't invest as much in those companies, so the overall gains aren't as high. Beyond Meat is my second largest position and largest actual investment. Chewy is third, followed closely by DraftKings, and then Square is my 6th biggest holding. I can't picture myself selling out of any of these companies anytime in the next few years. I plan to keep adding consistently to all of these positions. I'm extremely bullish on each of these companies for various reasons. Tesla is Tesla. Beyond Meat is changing how people see plant-based food and rapidly expanding globally. Chewy is the largest pet supply delivery service in the US and growing rapidly. Square is one of the largest fintech companies and set to be a major player in the disruption of brick-and-mortar banking, while offering truly innovative point-of-sales technology. And DraftKings is already the most used fantasy sports app with a solid foothold in sports betting, which is only set to gain more and more mainstream usage as it becomes legalized in more states and sports return to some normalcy following the pandemic. Then there's my penny stocks, all of which are Canadian. I have 7 penny stock holdings. The returns on some of these have been amazing. Greenlane Renewables and Zebek Adsorption are 2 of my best performers and 2 renewable companies I'm really excited about long term. Greenlane focuses on renewable natural gas, while Zebek is focused more on the hydrogen industry. If you want a more in-depth look into Greenlane, check out my other video where I do a deep dive into the company and outlook going forward. Then, I have 2 psychedelic medicine companies, MindMed and Numinous Wellness, or Numi. These are definitely my 2 most speculative holdings. I love the potential for both companies going forward, but neither have much or any revenue, are trying to transform traditional medicine using currently illegal substances, and have yet to successfully complete widespread clinical trials. I'm extremely bullish on both of these companies in the long term, but have absolutely no idea how long it will be before alternative medicine is considered acceptable. I hope that happens sooner rather than later, as mental illness and opioid addiction are 2 serious problems plaguing society at the moment. I have a small position in The Score, which is essentially a turnaround play as they've been a sports news company for decades and the stock hasn't done much but go down. The Score is another sports betting app that is also looking to venture into the realm of e-gaming. I'm interested to see if they will be able to capitalize on the exponential growth we are witnessing in esports. The stock has already started to show signs of turning around, as it's up over 280% in the last 6 months. Next, I have 300 shares of Drone Delivery Canada. The name is pretty self-explanatory. Still a young company with barely any revenue, the potential for this business is enormous if they can figure out the logistics. I do expect drone delivery to become more and more common over the next 5 years. Hopefully they can take the majority of the market share if/when that does happen. And lastly, the only company that I'm really down on in my portfolio, about 25% at the moment, is Patriot One, a security company that specializes in threat detection solutions in public spaces such as schools, stadiums, airports, hotels, concert halls, and shopping centers without the need for human interaction. Their technology allows detection of threats such as weapons, explosives, fights, riots, and even health safety issues like elevated body temperatures. Given everything going on in the world right now, I think this company will absolutely take off when things start to open back up. Their technology seems to provide viable solutions to many issues impacting public security. They are finally starting to make some revenue, so hopefully that will continue to grow in the coming years. So those are all of my holdings. My top gainers in terms of percentage returns are number 1, The Score, I'm up 320%. Number 2, Afria, I'm up 183%. Number 3, Zbeck Absorption, I'm up 168%. Number 4, Green Lane, I'm up 155%. MindMed, I'm up 148%. Tesla, I'm up 113%. And Drone Delivery Canada, I'm up 101%. So I'm up over 100% on 7 of my 20 holdings, while only down on 2 out of the 20. And one of which is MP Materials that I just opened a position in last week and plan to continue adding to over the next couple months. All in all, the performance of my portfolio over the last year has been outstanding. Now, obviously I can't expect to get 50% returns every year, and this may have just been beginner's luck or the result of an abnormally hot market. But I think this approach can consistently provide much higher returns than the overall market without taking on much more risk. It's also far more exciting investing in innovative, disruptive companies. My goal is to achieve returns similar to those of Peter Lynch. He averaged 30% returns for 13 years straight from 1977 to 1990 during an extremely volatile period for the stock market. 1 down, 12 more to go. The best thing about investing is that you don't have to pick one approach. It's not a religion. There isn't one right way to do it. Learn from the best and apply those lessons to your own strategy. Warren Buffett and Charlie Munger, Peter Lynch, Cathie Wood, Chamath Palihapitiya, Mark Cuban, Kevin O'Leary, they all have different techniques, but have all been able to amass an absolute fortune by investing long-term in good companies. So here's my advice to you. Find a strategy that works best for you. Everyone has a different financial situation, different interests, and different goals. Maybe rapidly growing your wealth isn't a priority for you at this stage in your life. Maybe preserving it and having steady, passive income is far more important. In that case, I would not advise my strategy at all. I'm single with no kids, 33, and able to assume more risk than someone that's married with kids to support, or someone that is older and looking to retire in the near future and live off their dividend income. Eventually, that time will come for me as well. But I want to have a much larger portfolio before I worry about living off the dividends. Right now, my goal is rapid growth. We'll see if that strategy pays off, or if this all proves to be a terrible mistake. I'm confident that it won't be. Only time will tell. I would love to know how long you've been investing for, and what your goals are for your portfolio in 2021. So please leave a comment in the comment section below. So I think that's a wrap, ladies and gents. If you made it this far, thank you so much for sticking with me this whole time. Please tickle that like button. And if you want to follow the journey and be notified of future videos, please smush that subscribe button. Thank you very much. Until next time, be safe, wear a mask, and invest wisely.